A very warm welcome, everyone. My name is Jan from Kenanga Futures, and I will be your host for tonight's webinar titled West Texas Intermediate Crude Oil Futures and the Key Factors to Know Before You Get Started. Thank you for spending your precious time to join our webinar tonight. We have returned with our nationwide campaign, Accelerate into the Future. Stand a chance to win prizes worth up to 50,000 ringgit when you trade Malaysian or US futures contracts from the 2nd of August till the 29th of October. Please take note that this webinar is purely for educational purposes and is not in any form or manner of trading advisory. Kenanga Futures Sendirian Berhad accepts no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. So before we start, we would like to take this opportunity to invite you to our next webinar on the 14th of September, Tuesday, 7:30 to 9 p.m., where you will explore the key fundamentals and technical outlook of US indices with Daniel Ang, Executive Director of Trade Vault Singapore. An invitation email will be sent to you shortly after this webinar, so don't miss out. Please remember to register once you receive the email. Next, if you have any questions for our speaker, please post your questions in the chat box and we will attend to your questions during the Q&A session. To pose your question, please draw your attention to the bottom of the chat box. Click on the text bubble icon and it will switch to Q&A chat mode. You may then type in your questions into the chat box. So today we have Mr. KAMAL and he's going to share with us about micro West Texas Intermediate Crude Oil Futures. Without further delay, I would like to kickstart our webinar by welcoming our speaker today, Mr. KAMAL. KAMAL, over to you.
Okay. Thank you, Jen, for the welcoming remarks. Okay, so welcome everyone. My name is KAMAL. I'll be your speaker for tonight, and I believe that tonight is going to be quite a good session because Kenanga Futures actually just launched our new products, which is the micro crude oil, the smallest one. So it is, if you are one of the few that have want to have exposure into oil but have a limited capital, then I think you guys should hear this out. Okay, moving on. This is the disclaimer. Everything that every examples, every charts, every prices that I'm going to show, perhaps it's a form of education, will be a form of educational material. Okay, is any losses that might arise from this examples or advice, we will not take any responsibility. Okay, so tonight's agenda is going to be divided into 4 parts. Okay, the first is of course a little bit of introduction of crude oil, and second one is factors impacting crude oil, the supply demand side of OPEC and so on. Third one, of course, I'm going to show you examples of what are some of the popular technical indicators that usually, of course, but these traders, like global traders, use for trading. And of course, lastly, is going to be about market outlook on crude oil. Okay, the first part, let's go. So WTI crude oil futures. Okay, so basically I'm pretty sure most of you know the fundamental, the basic of futures. So WTI crude oil futures is basically the futures contract that has underlying assets, which is the crude oil, the WTI, not the Brent one. It's basically a light sweet oil that serves as one of the main global oil benchmarks, along with the Brent. It is sourced primarily from inland Texas, and it's one of the highest quality oils in the world, which is easy to refine. And then WTI is actually the underlying assets for the crude oil, NYMEX oil futures. And of course, when we say about oil, right, usually people will compare and say, when we say about benchmark oil, people usually refer to Brent oil or crude oil, WTI crude oil, because those are the two biggest oil benchmarks globally. And the key features for this oil contract is, of course, it's better quality and high liquid due to heavy participation from related industry players, hedge fund and money managers. And of course, if you want to have exposure in the oil market without any extra management fees like ETF, right? It's you can actually go for futures because it's pretty much cheap in terms of the costs related to the cost of the trading. And in terms of the trading hours, it's almost 24 hours. Like we have Asian hours, we have US hours. So technically, most of the time, Asian hours have a relatively lower volume compared to the US hours, which is at night. On Asian time is about 9:30 all the way to 4 a.m. And of course, when we talk about supply side, right? So these are the top countries last year, right? Based on last year, in terms of their producing output, right? So as you can see, actually, US has for the last few years, US has been the main or perhaps the biggest oil producing country in the world. But US is not part of the OPEC, so technically they don't have any some sort of obligation to fulfill the cartel or the organization vision to mitigate oil prices, right? So it's all back to supply and demand and of that country. So that's a little bit which is something that we're gonna discuss later on. But this is just generally the top 10 biggest crude oil producers as of last year. Okay, next slide. Okay, and then these are the 20 countries with largest proven crude oil reserve. As you can see, actually Venezuela, Saudi are the two biggest. That's why they have such influential exposure in the OPEC community, right? And as you can see, US is actually number 11 in terms of the reserves. This is pretty much the infographic of the oil reserves in the world. As you can see that actually Venezuela and Saudi are the two biggest. And okay, this is the demand for crude oil on the demand side. As you can see, last year, which is of course everyone knows, it was the COVID year, right? COVID shock. Actually, the demand generally, of course, from year to year is actually increasing because of the population is getting bigger globally, right? So, so the demand will always go up in the near future, considering the extensive use of the oil worldwide. So as you can see, last year was actually a 8-year low kind of demand. It's the same as close to 2011, 2012 kind of range. So that's why, because of the lockdowns and everything, so that's why last year was a very volatile and bad year for oil worldwide. And these are the top 10 exporters and also importers. As you can see, by value, right? By value, the top 15 countries, the top biggest exporters, right? Is ship about close to 86% of globally exported crude oil last year. And but of course, if you look like on a year-to-year basis, last year was quite relatively low because of the COVID and everything. So, but of course, in terms of the ranking and everything, this is basically the top 10 for exporters and importers. Right, and you can see that US actually quite, China, US actually quite significant in terms of their share market in terms of imports, right? So any changes in terms of reducing policies or to increase imports or exports is basically will affect the oil prices. If we look like generally from the logical sense in terms of supply and demand. This is just infographics about U.S. major crude oil pipeline. You can see the Texas and Oklahoma. In Texas and Oklahoma, they have like quite a compared to other states, right? They are actually the biggest in terms of the pipelines. They have a lot of reserves going on over there. And this is the global refineries. As you can see, most of the refineries are actually located in China and the US and also the Saudi Arabia. And of course, for the last 7 to 8 years, there's been a rise of shale oil. So the differences, basically the difference between the conventional oil and also the shale oil, is that how the shale oil and also the conventional oil being collected, right? So the oil in shale is typically found in smaller batches, right? So as a result, like shale oil is often needs to be fractured so that the oil is trapped within the shale. So as technology advanced for the last few years, this has been like quite a supply disruption to the conventional oil, because as you know that US is actually has in terms of the pioneers, right? US is actually one of the first and also the pioneers in terms of the technological advancement of the shale oil, right? The drilling and so forth. So because of this, the US has been pushing to produce more and more shale oil to actually put them some sort of into a state where they are not actually dependent on the oil, the conventional oil imports. So because they can actually make the shale oil themselves, and they want to be one of the main exporters. So that's what they have been doing. Later on, I'll be showing the rise, also the of shale oil, and also the differences between the US crude oil imports and also the shale oil production. So as we will see a much more clear picture in terms of the world demand after this. I'm going to show you. And this is this is the global shale oil and shale gas resources. And so when we talk about crude oil futures, it's all about the contract specs, right? So this is the main one, the main contract, which is the biggest. So as you can see here, the size is actually 1,000 barrels, right? The minimum fluctuation is 1 cent. That is equivalent to $10 per tick, right? And it's a physical settlement contracts, and the latest margin, right, the capital that you need to initiate one lot of crude oil is actually about 5,006 as of today. So it's about, that's in terms of ringgit, that's about 4.4 times, close to 30,000, 29,000. But of course, this is the main one. And then the second one is actually the E-mini crude oil, which is the smaller version of the crude oil. And as you can see here, the contract size is 500. The main one is 1,000. So the E-mini one is actually 500 barrels. But something that you have to take note, actually the minimum fluctuation is actually 2.5 cent. If you see here on the main one, it's actually 1 cent. So the fluctuation is actually, the minimum fluctuation is actually higher. That's why the minimum tick is actually 12.5 per tick. But of course, in terms of the size, it's actually smaller, and the margin is actually half. It's basically half of what WTI, the main one, and the mini crude oil, the WTI crude oil requires. And of course, the settlement is financially settled, so you don't have to be concerned about the settlement and the expiration date. And of course, lastly, this is the new one, right, that we have launched officially as of yesterday. The micro crude oil, the smallest one, is the size is actually 100 barrels. The minimum price fluctuation is actually the same as the main one, right? 1 cent, but of course it's equivalent to $1 per tick. and it's the latest. The margin is pretty much about 10% of the main one, right? The main one, which is about 5,000 plus. So this is suitable for you guys that have that want to have exposure but quite concerned about the capital lah. So this is one of the options for you. And as you can see on the statistic that I have pulled out from Bloomberg, right? Year to date, as of 2021, as of January all the way to September, year to date, right? The average daily volume is about 980k millions, right? That's quite well. Actually, there's a typo there. It's actually 980k, not millions, right? But the average open interest is 2.4 million. Right? So in terms of the liquidity, is pretty much enormous, right? You can easily in and out within a few seconds. There will be buyers and sellers. Average daily trading range is actually about $2, right? So that's the high and the low. The range is about $2. That's equivalent to close to 199 ticks, which translate about in terms of dollar value is about 1,990, like close to 2,000 for the main one. Like for the E-mini, it's about 80 ticks, which translate about close to 1,000. And of course the micro, the smallest one, it's the same as the main one, right? 199 ticks. But of course, because of the smaller margins required, it's basically about 199, $2, about $200, right? In terms of the fluctuation value. This is quite something that you can actually take note about. If you want like some sort, for example, if you want to day trade oil, right, and then you say that okay, maybe my target is actually with my capital, and then my target is actually $100 per day. So so if you want to get like at least $100 per day on one lot, right? So for the micro is pretty much hard, because basically that's about 50% of the total minimum average tick. So but for E-mini, also the main one, $100 a day is actually pretty much possible, because it's just about 10% for the E-mini, and also about 5% for the main contracts in terms of $100 compared to the value, the dollar value of the trading range. So this is something that you can take note about in terms of the figures. And okay, moving on. This is the movement of the crude oil prices for the last 20 years. As you can see, oil is basically is very volatile in terms of month to month movements. And last year was quite was the peak of the volatility, I would say, because of the COVID shock and everything. But this is generally the movement for the last 20 years. And of course, when we say the factors impacting crude oil prices, this is just this infographic is basically the general factors, right? Of course, we have on the left side is the supply side, right? The demand side is on the right side, which is the whole ECD. Is basically they will collect the total number of imports, right, per countries and so on. On the supply side, of course, is about the production by the OPEC, also the non-OPEC, and then of course there's a spot price in the middle, and we have to find the balance, right, between the supply and demand. Then they will these factors will influence the spot prices, which is the oil prices. So this is the general overview. In terms of the more extensive one, of course, when we say about demand, right, how to measure demand? Okay, so that's I think that's the question. So on the demand side, we oil traders usually see GDP reports, right, the economic growth of the globally, or also the US, or and the top produce. Sorry, the top importers. The GDP for the top importers for oil, like the China, the US, India, and so forth. Basically, because of more economic activities, meaning more and more people need to travel and use oil. So that's basically the logic sense of it. And then of course the supply. Will usually investors look at inventories, like the weekly inventories that's going to be released by EIA, and of course the global production. So this demand and supply, these two have to be balanced to to ensure the oil prices is stable. And of course, OPEC and allies related policies. This is basically every 2 months they're gonna have like a meeting, which will set, and also which will set the organization mission, or perhaps the intention to cut supply or increase supply based on the current sentiment of the oil market. Of course, geopolitical issues such as wars or elections that's gonna affect the oil movement. Environmental and social, weather events or natural disasters, that this of course will affect the supply side if something bad were to happen in the supply side, like in the refineries and so on. Import and export policy changes. For this is related back to the countries, like importers and exporters, the top ones. So any changes to the countries will eventually affect the oil prices. Government policy changes, adaptation of alternative energy sources, and of course US dollar, because oil is pegged in USD. So if US dollar has is going down, for example, devaluation of US dollar has been going on for the last few months, that's pretty much indicate that oil prices are quite cheap, because US dollar is getting lower and lower. And this is the OPEC members, right? So OPEC members have usually they have been they have been always influential to the global oil prices, right? So this usually people refer the OPEC, right, as the cartel, right? So usually this OPEC, the cartel goal is to exert control over the prices of oil, right? Because OPEC Plus actually controls over 50%, right? 50% of global oil supplies, and about 90% of our reserve globally. So anything when we talk about 50% supplies and 90% reserve, any direction or any disputes that are going on between them will definitely affect the oil prices. This dominant position ensures that the coalition has a significant influence on the price of oil, at least in the short term, right? Because it's always hard to predict the long-term price of oil, because over the long term, its ability, the OPEC's ability to influence the price of oil is usually kind of diluted, right? Because individual nations have different incentives than OPEC Plus as a whole, right? Of course, I mean, for example, in the last meeting, they can say that, okay, you know what, we're gonna cut 1 million barrel per day, but of course, individually, like they all have different incentives as per country. So sometimes, if you can see on the next slide here, this is the unplanned supply disruptions, right? So sometimes the OPEC can set direction in terms of how many production and outputs they're gonna control. But of course, when we look at year on year, the disruptions, meaning that on the supply side, sometimes it can happen because of geopolitical tensions or something quite individual related to that particular country. So unplanned supply disruptions will, year to year, as you can see, is usually about 4 to 5 million per year. So there will always be supply disruptions. So it's hard to say that the target of the forecast of the production or the supply side is pretty much can be predicted lah, I would say, generally. Okay, this are the important industry data. US API, US EIA, weekly inventories. reports that's gonna be released every Wednesday, 10:30 p.m. So usually the EIA weekly stockpiles, right, or inventories, the other name for the stockpiles. Oil producers and government use this data usually to smooth out the impact of changes in supply and demand of oil. Right? So it is very usually oil investors and traders globally will ensure will take note of this EIA weekly reports because this EIA inventories, the stockpiles, right, the measures the weekly change in the number of barrels commercial oil held by the US firms. So this level of inventories influence the price of the oil, which can have an impact on inflation sometimes. So this is very important data to take note. And of course, when we say about stockpiles, inventory, the definition of a stockpile is crude oil stockpiles are basically the reserves of oil measured in number of barrels. So this oil producers and government use this to smooth out the impact changes in supply and demand, which is later we'll see there's actually a correlation between the price of oil and also the EIA weekly inventory reports. And this is the shale oil and also crude oil production. As you can see, since the last few years, shale oil has been quite dominant for the US. So this actually diluted, somehow diluted the total monopoly of OPEC. And when we talk about shale oil, US have been quite aggressively promoting also export the oil that they've been producing. And of course, among the Asian nations, South Korea has been one of the most important market for US oil. As you can see in the next slide, we have a chart here. So for the US crude oil export, right, for the US alone, actually has been quite significant in Asia and also the EU market. It's been in terms of the global destination is actually getting bigger and bigger year to year. This is another one. And of course, when we talk about crude oil, you can see that the three biggest importers, right, India, US, and China. Year to year, there have been quite stable increase for India and China in terms of the imports. But actually, as you can see, for US, it has been declining since 2015 because of the shale oil. As you can see in the next slide, the US crude oil imports actually have been starting to decrease since 2007. But of course, the US shale oil production has been quite aggressive and it's been supporting the US dependent of oil for the last few years. So they actually, that's why, as you can see here, US in terms of imports, right, the US has been quite low on the it has been in declining state, I would say, because of the shale oil production and capability to produce the shale oil. And this is the OPEC plus and also the US crude oil production versus the price. As you can see, US has been since 2019, US before the COVID, of course, they have been quite significant also quite become a big player in the market, right, in the crude oil market themselves. So as you can see, the production by OPEC has been lowered down since 2019, and it's hard to go at least to the 2018 high, at least for the OPEC in terms of the production, because they are aware of the shale oil dominance in the market. And this is the US dollar versus oil. Generally, of course, when we say the US, the crude oil is back in USD, so any kind of devaluation for the USD actually good for the oil price in terms of how relatively cheap oil is, right? So, but of course, when we compare both of them side to side, they're actually it's hard to say because actually there are so many other factors, external factors that are affecting the oil prices, the oil movement, right? So yeah, this is just a general comparison side to side, USD versus oil. And this is the money managers net positions. Basically the smart money. I would say the yellow one, as you can see. So the as you can see for the last, at least for the last 10 years, right, for the last since 2010, it's been I mean, money managers have always been for the longest of time, right? The last 10 years, money managers have always been in a net long position for oil. I think the last one when they were like negative was close to 2008 after the crisis GFC, but since then they've always been net long for the money managers now. When we say money managers, those are the fund managers, the smart money. And this are the monthly seasonal performance, right? For the last 5 years. On the top, you can see that usually, of course, usually, not necessarily, for the last 5 years, the last 2 months are actually quite bullish for oil prices. And usually the first couple of months, the first quarter usually bearish for the oil prices. So of course, this is just a seasonal performance. It doesn't really, it's hard to say in terms of the significance, because as you can see, last year March was quite 2020 was quite an outlier, so it somehow affect the overall average of the last 5 years, because you can see March last year it was down 54%, and then rebounded back about 80% in May. So it's very outlier kind of market. So of course, if you see, look on a 10-year average, right, it's pretty much almost the same in terms of the last quarter. Usually it's mostly negative in terms of the average, but of course this is something that it's more on a performance side. Yes, there's quite nothing. It's hard to predict just based on this, but of course this is something that you might find useful in terms of the month-to-month performance for oil. Okay, so the next agenda, of course, the popular indicators that people usually used for crude oil. And the first one, of course, is MACD. I'm pretty sure it's quite famous. I'm pretty sure it's a well-known indicator. It's quite famous, so pretty sure a lot of you are quite familiar. It's basically a flowing momentum indicator. By default, of course, it's 26 and 12, right, EMA. This slide basically uncovers how MACD develops, like 26, 12, and of course we have like the 9-day EMA called the signal line. So the interpretation, the basis is basically crossovers, divergence, rapid rises, falls. There are some weaknesses, of course. It's a lagging indicator, and the highlight, of course, the crossover is quite reliable. If you can see on the daily or on a weekly trend. This is based on our KDF platform, the MACDs, right? So the prices, as you can see, the prices and also the MACD crossovers is quite at least on the longer time frame, you can at least trade a shorter time frame based on the longer time frame. So it's assuming if it's in the golden crossover for MACDs, then you might want to buy when there's a dip, when the MACD is actually in bullish crossover, something like that. So it's just an overall momentum indicator. But of course, if we are if we look at the back testing on Bloomberg, we can see that of course everything is automated, right? Long and short, when the MACD is showing bullish or bearish crossover and so forth. So as you can see, the total number of trades actually are 186 for long and shorts. Of course, the win rate is actually 47 and 36 respectively. Right, it's about 80. It's almost the 83. So that is about close to 30%, and the actually the losses are quite huge. But of course, if you look at the PNL, it's quite the average PNL is about 206, and the short side on the long side, and for the short side is about 442. So this is pretty much of course this is automated, so it's pretty much you can some sort of a bet based on the automation. At least you can believe that on a longer time frame, MACD actually works, right? On a sound basis, I would say. And of course, the next one is parabolic saw. This is quite interesting. It is used to determine the trend direction and potential reversals in price. It appears on a chart as a series of dots, either above or below. A dot below is actually deemed to be a bullish signal, right? If it's above, then of course it's the total opposite, it's bearish. Let's see the chart here on our platform. As you can see, there's a dot, a series of dot lines, right, above and also below the prices, below the candlesticks. So whenever there's the dotted line started to appear up on the bottom of the price, so technically it's deemed as a bullish signal, and conversely on the upper side of the price. And if you used back testing on a ADK capital, one lot, right, just maintaining trades in and out, one lot, this is the total result. Winning ratio is actually a close to 43%, right? So it's not it's lower than half, lower than a 50-50. But as you can see, the the total the average PNL for long is actually 125, right, dollars, and short is actually 300 plus. And in terms of the losses, the average win and losses is actually quite okay, right? The average win is actually 3,000, versus the average losses is about 2.8 thousand. Max win is about 10K. Max loss is about 7K. So this is based on the back testing. Next one, stochastic oscillator. This is in terms of how to interpret, it's relatively similar to MACDs, right, in terms of the crossover. But of course, it's stochastic is more sensitive. Right? So it's if you look at MACD, it's a more lagging kind of indicator. This is a more sensitive and leading because of the formula and also the calculations. As you can see on the chart here, there's a level 80 and 20, the overbought and also the oversold. And whenever the price, the red line is above the blue line, is deemed as the bullish signal, and the I would say a good time to buy also the short is actually when there's a crossover below the oversold, right, for long side. Right? So if the two lines are below the 20, which is considered as oversold, and then there's a crossover going on, the bullish one. So it's a good time to buy generally. And then of course when the stochastic is above 80 level, which is deemed as overbought, so it's a good time to short, right? Based on backtesting, 50K capital, the winning ratio is actually 43%. This is the result, basically. And of course, the last one is of course the RSI. This is quite famous. Which is just the interpretation is basically 70 and 30, right? It's the same as the stochastic one, but it's 70 and 30. Overbought values is 30 and below, and oversold is above 70. And then of course when if you look at this one, whenever the RSI is above 70 is deemed as overbought, right? And whenever it's below the 30 is considered as oversold. So this is just pretty much where you can timing your entry, or whether you want to go long or short based on RSI. It's one of the options. Of course, backtesting based on 50K. The winning ratio is actually quite is the highest so far. It's like 80%, 83%, right? As you can see on the most bottom one, right? The percentage winning ratio is actually 83%. And because of the RSI, it's very the overbought and also the oversold signals is quite it's not as common as stochastic, right? So so the total number of trades is actually just 18. The total, right? Based on few years. This is, by the way, the daily chart. So based on the daily chart, for the last few years, the total number of long and short actually is only 18. So it's quite. For RSI, you don't have to be in the market all the time, something like that. So but of course the percentage winning is 83%, and the average PNL also you can see on the long side is about 1.4. And the short one is 4.2. This is pretty much the result of backtesting. And of course, the next one gonna this is the summary of all the indicators that we have discussed. Of course, capitals. I mean, the capitals are quite different because some indicators are quite I would say aggressive. I would say some indicators are lagging and some also leading, right, in terms of the formulas. So for indicators that have less signal, usually we go for a slightly higher capital also. So as you can see, number of trades, number of wins, number of losses, PNL of the total PNL. That's about more than 50% for them. But of course, this is excluding the charges and brokerage charges and data fees that might be charged on your banks and also brokers. This is just a plain based on the PNL and also the backtesting trades. So we have cleared out the technical indicators. Now let's jump into the market outlook for the third quarter of this year and all the way to the first half, right? So crude oil market outlook. Please be reminded that the next data on the next slides that I'll be showing is subjected. Of course, this is based on the conservative, also the base case in terms of the global economic recovery from COVID-19, because as based on the next slides and the next data that I'll be showing, right, it's more on how the good case, I would say, right, assuming if there's any more concerned variants of COVID-19, the MUs, the Delta, the Beta, and so forth. We never know in the next couple of months. There might be something more scary and deadly. You never know. So, of course, based on the projection in terms of vaccination, also the US GDP and the global economy, right? As you can see here, is the US GDP is forecasted to grow about 6.6% this year and 5% next year. Global economy, the global is expected to grow about 6% and 4.9% next year. This is based on IMF. This forecast, of course, is based on continuing economic and increasing mobility. Any developments that would cause deviation from this, like I said, will definitely impact the forecast. But of course, based on the last meeting, right, the OPEC last meeting in July 18, they actually expecting production to be relatively flat all the way to October before it starts rising in November to cope with more and more demand in terms of the global global recovery, also the rise of mobility, right, because of the vaccination and so forth. So based on this stance, right, the productions. On the next slide, as you can see, on EIA website. So as you can see, the one that I highlighted in the box, right? So the third quarter onwards, as you can see, the total world consumption, right? When we talk about oil, is about the demand and consumption. It's based on the stance of the OPEC stance, relatively, right? So the next onwards is going to be at least 99 to 100 in terms of total liquid consumption. That's actually quite relatively higher compared to the last year because of the COVID and everything. But so they're actually expecting in terms of normalization in terms of demand consumption by end of 2022, right? Generally, because right now, if the next few quarters, if we assume that the next few quarters, the consumption, total world consumption is about 99 to 100, that's pretty much we're gonna go close back to the pre-COVID the pre-COVID levels, right? So so by estimates, they are expecting the normalization and before of the crude oil consumption is actually can be achieved by end of 2022, next year, based on the estimates and forecasts. And of course, this is the supply side. As you can see, the last year, like the second quarter of last year, it was relatively low because of the COVID and everything. And as you can see, the next few quarters, we are expecting, in terms of the supply, we are expecting the quite flat, right? Quite flat. But actually, the consumption is actually getting bigger and bigger. Going to be increasing for the next few quarters. But of course, in terms of supply, they're maintaining. The forecast indicates that we are actually maintaining between 19 to 20 range, which is actually relatively higher compared to last year, 2020. Sorry. And as you can see, the forecast by the EIA, the world consumption and the world consumption should be normalized by end of 2022, which is about the same level as 2019 and 2018 range. So in terms of the production, that's why OPEC have agreed to increase production the next 2 quarters by end of the year. They're gonna increase production to cope with the increasing consumption, right, after the COVID aftermath because of last year's. So they actually going to increase production to cope with the productions. As you can see on the top, on the bottom, right, there's the implied stock and also the implied draw. As you can see, the implied stock build gonna be slightly on the positive side. Starting by end of this year, right? It has quite it's slowly, gradually increasing to the positive side in terms of the stock build, because we have been in the negative implied stock draw for the last few quarters because of they want to try to clear off the stock build that were too high in COVID shock last year. So yeah, but of course, based on this, we are expecting more and more excessive in terms of the stock build moving forward in 2022. And of course, the downside risk is, of course, the vaccination program and also the rollouts. It will not be evenly across the globe because of different geographics and also different pocket size of the countries, I would say. And based on this, right, based on all the data that I've showed you, this is basically the estimate spot prices for crude oil, WTI crude oil, right? It's actually, we are based on this, we have actually reached the top, like 77. I think last month, we have reached the top for now, 2021, by about 76, 77, close to 77, and it's actually going downhill from here. based on this forecast, and also based on these the implied stock build that, and also the normalization between production and consumption, right? So we are expecting, they are expecting, the EIA is expecting there's actually going to be more downhill from here, like in terms of the oil, the prices of the oil. And when we look at inventories, right, the end inventories of the stockpiles, right, the stockpiles and also the crude oil prices for the last, this is the data for the last 10 years. I've pulled out data from Bloomberg. As we have discussed earlier, oil prices will react on a weekly inventories, right, the stockpiles, as investors gauge this figure, like the EIA figure weekly, to somehow have a sense for the supply and demand side, right? So as we know that this for the stockpiles, right, the oil producers and governments use this figure to smooth out the impact of changes in supply and demand. And so this is very crucial. And as you can see from the data itself, actually the crude oil actually have quite a relationship. I would say about 76.2% of the oil of the last crude oil prices for the last 10 years actually can be explained by the ending inventories, ending stockpiles. So because of this, based on this method, right? Based on this method, based on the EIA, also the OPEC forecast, the end of inventories, right? The end of stockpiles for the third quarter, and fourth quarter is going to be 435 million, and also 440, close to 441 million. Per barrel. So of course, that will translate about the oil prices at the crude oil will be about 64 for the third quarter, and also for the third quarter, and also for the last quarter of this year is going to be about 62.96, and for the next year, the first 2 quarters is going to be more lower in terms of that, because we are expecting more and more inventories coming up, because they are gonna increase production from November. That's what OPEC has been the outcome of the meeting of OPEC last July. So they're gonna increase the production in November and moving forward, because they believe that it's gonna be the demand is gonna be higher. So it's pretty much. But of course, in terms of this method, it's pretty much indicate that the oil prices is actually going lower for the next few, I would say, for the next few quarters. It's actually going lower based on the supply and demand side. Technical outlook, of course, on a weekly chart, you can see that the price on a weekly basis, right, the price has actually broke below the 20 MA line for the first time since September, which is last year. This is actually quite a trend reversal signal, right? And as you can see on the MACD side, there has been a divergence going on for the last since March, right? The price of oil has been higher, but actually the MACD and RSI is actually quite flat. It's not increasing, so there's quite a divergence going on. And right now the MACD on a weekly base, on a weekly perspective, right, the MACD has been going downhill since the plunge, right? And even the resistance actually getting lower and lower on the oil, on the price movement. So we can see that there has been lower high formation going on for the last few candles. And in terms of the parabolic SAR, right now it's actually the dotted lines are actually on top of the candlesticks, so it's actually a bias towards the downside for now. But of course, as you can see, the overall 50 MA 50 moving average, which is the red line, is actually the price actually trading above the 50 MA line. So it's actually it's quite bullish per se on the overall trend. But of course, in terms of the last few the movement of the prices and also the indicators has been going downhill from here. And of course, because of this, the overall outlook now is neutral to mildly bearish. The range will be about 72.98, right? From, as you can see here, all the way to the at 50 MA. Like that is the projection in terms of the range gonna be. But of course, it can maintain bullish for oil prices if the price hold above the 58. But of course, it needs to be coupled with the improving MACD and also the parabolic SR on the weekly side, as you can see. So in order for the price to maintain bullish, it has to maintain above the 58 level. But of course, if that happens, then we have to wait for the MACD and also the indicators started to be bullish, I would say. But as of now, it's the indicators are showing a bearish signal, so it's biased towards the downside for now. So this is pretty much a two outcome, I would say. Yeah. So I think that's all for me. And now back to you, Jen, for Q&A.
Okay, thank you for the presentation, Kamal. We hope you guys found it useful and informative. We will now proceed to the Q&A session. Okay, I think that covers all for today. Kamal, is there anything else you would like to add before we end the session?
Oh, okay. So I think that's pretty much for me. I think gonna highlight the last one, which is basically the micro crude oil. It's just launched yesterday. It is new, so to all our clients and also who are interested to take advantage of oil with minimal capital can email us lah. So I think that's my last few words. Thank you.
Okay, great. Thank you, everyone. Should you have any further queries, please feel free to drop us an email at featuresmarketing@kenanga.com.my. We appreciate you being here and hope that you enjoy the webinar today. Please take a minute to rate our webinar, and your feedback is highly appreciated. We will post the link in the chat box. Meanwhile, would you be interested to trade global futures products that are not currently offered by us? So please let us know by completing a form, which will also be posted in the chat box below. So again, don't forget to register for our next webinar. Thanks again for joining us, and hope to see you again next week. So good night and stay safe, everyone.
What are you clicking?
Click KenangaFutures.com.my, Malaysia's leading derivatives broker.